Welcome to another deep dive. Great to be here. Today, we're plunging into the world of CVS Health, specifically looking at their second quarter 2025 performance.
Right. And we've got some solid source material, the earnings call transcript, and their Q2 2025 10Q filing. Lots to unpack.
Exactly. Our mission. Sift through it all, pull out the critical insights, maybe some surprising facts, and help you really understand what's going on behind the headlines. It's a huge player in healthcare, after all.
Yeah, and we'll try to connect the dots for you, give you a clearer picture of their current landscape. Not just the financials, but, the big legal and regulatory challenges they're facing, too.
It's a complex stuff.
Definitely. Trying to give you that well-rounded understanding of this integrated health solutions company. Help you see past just the surface numbers.
Okay, so speaking of numbers, when I first looked at the headlines from the earnings call, well, there was a lot of positive buzz, wasn't there?
There was talk of strong performance, a $600 million beat on the core side for Q2.
And the revenue, on the surface, was impressive. Almost $99 billion. That's what, an 8.4% jump from Q2 last year?
Yeah, big number.
But hold on, because this is where, well, the plot really thickens, as they say. When I dug deeper, past that shiny top-line growth, something quite different emerged from the Q2 financials. It actually surprised me a bit.
That's exactly right. That's the key takeaway here. What really jumps out is that despite that revenue growth, net income for Q2 2025 actually decreased.
Significantly decreased.
Yeah, quite substantially. It dropped to just over $1 billion from $1.7 billion in Q2 2024.
Wow.
And diluted earnings per share, basically the profit per share of stock, well, it followed suit. Plummeted from $1.41 to just $0.80.
Okay, so why the huge gap? Revenue up, profit way down.
It really stems from these massive legacy litigation charges, basically big payouts for past legal issues.
How big are we talking?
$1.2 billion total, plus another $288 million in pre-tax losses from their accountable care assets, those provider groups they've bought.
Right.
And these big hits, they landed hard on the pharmacy and consumer wellness and health services segments.
So they just wiped out any gains elsewhere.
Pretty much. They completely offset the operating income increase from the healthcare benefits segment. And ironically, they even swallowed up the benefit of not having that $100 million opioid charge from last year.
It's like one step forward, two steps back with the legal stuff.
Kind of feels like that this quarter, doesn't it? They clear one major legal issue only to get hit by an even bigger wave.
So what's the core takeaway here for you, the listener? What does this tell us?
Well, it really shows that just looking at top-line revenue can be, frankly, misleading.
Dangerously so, maybe.
Yeah. This quarter really demonstrates how even strong growth can be totally overshadowed by these one-time non-operational hits.
It makes you question the underlying profitability, doesn't it?
Yeah.
How clean is it going forward?
Exactly. And how vulnerable is it to these kinds of maybe recurring legal and operational challenges? This isn't just a blip, it gives you a real look at the inherent risks in their complex structure.
Okay, so that's the big picture. Revenue up, net income down, mostly because of those litigation hits. But where are these pressures actually playing out day to day? Let's break down the main business segments.
Okay.
So CVS Health operates across, four main areas?
Yeah.
Healthcare benefits, that's Aetna for most people.
Right.
Then health services, pharmacy and consumer wellness, and corporate other. And their big goal, they say, is personalized care, access, better outcomes, lower costs, the usual stuff.
The standard healthcare mission statement, yeah.
Oh.
So looking at healthcare benefits, Aetna, they actually have a strong Q2 overall.
All right, okay.
But, and this is important, their group Medicare Advantage business continued to be pressured. That's mainly from elevated medical cost trends.
Meaning people are just using more healthcare.
Essentially, yes. More services, higher costs. Plus, their Medicaid business is also seeing pressure. That's driven by higher acuity post-member redeterminations.
Okay, translate that.
It means after they rechecked who's eligible for Medicaid, the members who remain tend to have more complex and therefore more costly health needs.
Got it. And there's a big strategic shift happening too, right, in the individual market.
Yeah, this is pretty significant. The CVS Health plans to exit states where Aetna operates on the individual public health insurance exchanges.
The ACA marketplaces.
Exactly, effective January 2026. They said it's due to declining membership in those products.
That could definitely cause some financial volatility as they unwind that, couldn't it?
It certainly could.
Yeah.
Something to watch. Now, turning to health services, those higher utilization levels we mentioned,
Yeah,
they're proving, in CVS's words, difficult to accurately predict.
I bet.
And they expect that to pressure both the Aetna side and their healthcare delivery assets, like primary care clinics, within health services for the rest of 2025.
Pressure meaning higher costs, lower profits.
Potentially, yes. It could even lead to them needing to set aside more money in premium deficiency reserves. Basically, funds to cover expected future losses if claims stay high.
And you mentioned specific assets.
Yeah, specifically their Oak Street Health business, that primary care provider they bought, it's experiencing unfavorable results and elevated pressure. That's definitely a flag for one of their key strategic growth areas.
Okay, let's move to the retail side. Pharmacy and consumer wellness, that's the 9,000 or so stores we all see.
Right. This core part of the business, it's facing its own challenges, particularly the front end of the store.
So not the pharmacy counter, but everything else, shampoo, snacks.
Exactly. That part has been a struggle for the industry generally. Lots of competition, especially online.
Makes sense. And within that segment, the PBM, the pharmacy benefits manager, that's huge for them.
Huge. 87 million plan members. But it's undergoing a major transformation.
How so?
Well, they're continuing to share more of the rebates and discounts they get from drug makers directly with their clients, like employers and health plans.
Okay. Less profit kept by CVS.
Potentially, yes. And crucially, regulatory changes are also limiting their ability to use differential or spread pricing.
That's where they charge the client more than they pay the pharmacy.
Correct. That traditional way PBMs made money is under real pressure. And these trends, they're expected to continue. It's fundamentally reshaping how PBMs operate.
It sounds like pressure from all sides for that segment. Any good news?
Well, despite those pressures, there is a potential bright spot. The segment is likely to benefit from incremental volume due to disruption across the retail pharmacy market.
Like competitors struggling.
Exactly, including acquiring prescription files and some stores from Rite Aid as part of their bankruptcy. So, yeah, one company's struggles might actually be CVS's gain here.
Okay, interesting dynamic now. Let's wade into maybe the thorniest area, the legal and regulatory stuff.
Yeah, this is a complex web.
It really seems to be having a massive impact on their bottom line based on those Q2 numbers.
It truly is a lot for them to navigate. Okay, first up, the PBM practices.
Right.
Multiple lawsuits are out there alleging that CVS's PBM setup led to inflated prices for certain drug products because of how the rebates work.
And the government's involved.
Yep. The FTC, the Federal Trade Commission, filed its own administrative complaint back in September 2024. They're alleging anti-competitive and unfair practices, particularly around insulin costs.
Okay, what else on the PBM front?
There's a separate federal case, U.S. XREL, Bank v. CVS Caremark. In that one, CVS was found liable under the False Claims Act.
Which punishes false claims for government money.
Correct. For misrepresenting PBM prices to pharmacies for Medicare Part D patients, they actually recorded a litigation reserve for that in Q2 2025.
So they set money aside expecting to pay.
Seems like it, though they do say they intend to appeal.
Okay, what about the opioid litigation? That's been hanging over them for years.
It has. And there's actually a notable, though kind of complicated, development there.
Good news or bad news?
Bit of both, maybe. The Ohio Supreme Court ruled in December 2024 that state law actually precluded the specific claim that led to a previous jury verdict against CVS and others. That was a big one, like $651 million judgment.
So that specific judgment might go away. That sounds like a win.
It does seem like a significant win in that specific case. However...
There's always a however.
Right. The Department of Justice, the DOJ, has intervened in a separate whistleblower lawsuit, a qui tam action.
Okay.
And this one alleges widespread violations of the Federal Controlled Substances Act and the False Claims Act related to filling opioid prescriptions nationwide. So progress in one area, but a potentially huge new federal case looming.
Wow, okay. That dynamic seems to continue elsewhere, too.
It does. Look at prescription processing litigation. There's a case called U.S. XREL, Basan v. Omnicare, and CVS Health.
Omnicare, they acquired them, right?
Yeah.
Long-term care pharmacy.
Exactly, back in 2015. So in April 2025, a jury found both Omnicare and CVS liable for improperly filling prescriptions.
What was the damage?
Well, interestingly, no direct damages were assigned to CVS Health Corp itself, but the company was found jointly and severally liable for $165 million of the $542 million in penalties slapped on Omnicare in July 2025.
So they're on the hook for part of Vondicare's penalty.
Looks like it. And that led to another incremental litigation reserve in Q2, and surprise, surprise, they plan to appeal this one too.
You definitely see a pattern. Big legal findings, big financial hits, and appeals planned.
Absolutely.
Now, this all raises a huge question about Medicare Advantage. The scrutiny there seems intense. What's going on with CMS audits?
Yeah, this is potentially massive. CMS, the Centers for Medicare and Medicaid Services, is regularly auditing companies like CVS that offer Medicare Advantage plans.
And the rules changed.
They did, significantly. The final RADV rule, that's risk adjustment data validation, came out in January 2023. It allows CMS to use extrapolation.
Meaning they audit a few claims and apply the error rate to everything.
Precisely. They can audit a small sample and then calculate potential overpayments across all similar contracts based on that sample's error rate. That's huge.
And didn't they remove some kind of discount too?
They did. They eliminated something called the FFS adjuster, which used to basically reduce the amount companies had to pay back for errors. That's gone now.
So potentially much larger repayments if errors are found.
Correct. And maybe even more significantly, CMS announced just this past May 21st, 2025, that it plans to audit every single Medicare Advantage contract every payment year.
Every single one. Every year.
That's what they announced, with an expedited plan to finish the audits for payment years 2018 through 2024 by early 2026.
Wow. The potential financial impact.
Could be material, as the filings say, meaning significant premium refunds or adjustments owed back to Medicare.
And is that the only Medicare pressure?
Not quite. The DOJ is also investigating diagnosis codes related to those risk adjustment payments under Medicare Parts C and D.
So, checking if the diagnoses submitted to get higher payments were accurate.
That seems to be the focus. And there's yet another whistleblower case, U.S. XRO, Andrew Shea v. Aetna. This one alleges kickbacks paid to insurance brokers to steer patients specifically to Aetna's Medicare Advantage plans, violating the False Claims Act again.
Man, it's coming from all directions. CMS, DOJ, whistleblowers.
It really is.
And just quickly, anything else? Stockholder issues.
Yeah, briefly, there are ongoing class action lawsuits and also derivative complaints from shareholders.
Derivative meaning shareholders suing for the company against management.
Kind of, yeah, usually against the board or execs. These lawsuits allege omissions and misrepresentations about the performance of their old long-term care business and also the profitability of the healthcare benefits segment more recently.
It is truly a complex web they're trying to untangle.
Or maybe just manage.
Okay, so amidst all these legal battles and regulatory storms, let's talk about their basic financial footing. How stable are they?
Well, on the surface, their cash position looks strong. Cash and cash equivalents jumped significantly, almost $11.8 billion at the end of Q2 2025.
Up from about $8.6 billion at the end of 2024.
Right, so plenty of cash in the bank, which looks good.
But? I sense a but.
There is an interesting counter trend you'll want to note. Net cash provided by operating activities, that's the cash generated from their core day-to-day business.
Yeah.
That actually decreased in the first half of 2025. It was about $6.5 billion, down from almost $8 billion in the first half of 2024.
So more cash overall, but less being generated by the actual business operations year over year.
Exactly, which is a key metric analysts watch for underlying financial health. It suggests maybe those operational pressures are impacting cash flow.
Okay, what about their investments? They hold a lot of those, right?
They do, over $32 billion in total investments. Now, they do report about $707 million in unrealized capital losses on debt securities.
Meaning the value dropped on paper.
Right. But the company states this is mostly due to interest rate increases, not because the underlying credit quality got worse.
And they don't plan to sell them while they're down.
Correct. They state they don't intend to sell, so those losses aren't actual cash losses unless they do. Their mortgage loan portfolio, about $1.5 billion, that appears pretty stable. Most loans are rated as having minimal to acceptable credit risk, so that seems okay.
So connecting this back to the bigger picture,
Yeah.
what are they doing strategically to try and, counter some of these pressures?
Well, they are actively trying to regain some control. They finalized an enterprise-wide restructuring plan back in Q3 2024.
Aimed at cost savings?
Primarily, yes. Streamlining the organization, they're aiming for over $500 million in cost savings this year in 2025.
And the Rite Aid deal helps too.
They expect it to, yes. Acquiring those prescription files in some stores, as we mentioned, could provide some needed incremental volume and help boost that retail segment.
Okay, so let's try and summarize this whole deep dive. You've got CVS Health, right, experiencing this pretty impressive top-line revenue growth, making strategic moves like grabbing parts of Rite Aid. But at the same time, they're just battling these huge, significant legal claims left and right.
Yeah, multi-front battles.
Facing really complex and potentially very costly regulatory scrutiny, especially around Medicare Advantage.
Right, the REDV audits are a big one.
And dealing with these elevated medical costs across their insurance and service segments.
And all of that, all those pressures are directly hitting their actual profitability, their net income.
It really makes it, I don't know, a delicate and pretty high-stakes balancing act for them right now.
Absolutely. So, recapping, we've dug into CVS Health's Q2 2025. We saw the impressive revenue, but then that surprising dip in net income, largely driven by litigation.
Right.
And we've unpacked the myriad challenges across their businesses: Medicare Advantage cost pressures, PBM model changes, the ongoing legal fights. The company is clearly navigating a really complex and, frankly, highly litigious environment, all while trying to integrate acquisitions like Oak Street and manage these persistent operational pressures like utilization.
So their ability to actually offset these pretty substantial headwinds with those planned cost savings and hopefully for them continued revenue growth, that's going to be absolutely key, isn't it?
It really is. That's the central challenge for their future stability and profitability, especially in this healthcare landscape that just keeps evolving.
So here's something for you to chew on as we wrap up. As this healthcare landscape does keep evolving, with new regulations, more intense scrutiny, how do you think companies like CVS Health, these huge integrated players, will have to adapt their core business models? How will they balance that constant pressure for profitability with their stated mission to improve health outcomes and manage costs for literally millions of people? What trade-offs might they inevitably have to make?
That's the billion-dollar question, isn't it? Something to definitely keep thinking about.